The money never sleeps, but sometimes it hides. Right now, trillions of dollars are doing something that feels almost wrong. They're not investing, they're not lending, they're not chasing growth. They're parking themselves overnight with the Federal Reserve. This is America's hidden money market, and almost nobody talks about it. Here's the uncomfortable truth. In a system built on risk-taking and reward, the safest trade in the country has quietly become doing nothing. That's why this matters right now. Because while headlines scream about inflation, rate cuts, and booming markets, $2 to $3 trillion in cash is choosing to hide instead of participate. And cash doesn't hide unless it's scared. So let's rewind. Back to March 2020, markets freeze, liquidity evaporates. The Fed does what it always does in a crisis. It floods the system with money. Trillions of dollars. Fast, aggressive, no hesitation. Banks get reserves. Money market funds get cash. The system survives. But here's the twist. That money never really left. It just started circulating inside a very small, very quiet loop. Enter the reverse repo facility. On paper, it's boring. Overnight loans, collateralized by treasuries, one business day at a time. But functionally, it's a pressure valve for excess cash. Here's how it works in human language. Money market funds, the safest, most boring pools of capital on earth, wake up every day with cash they must park somewhere risk-free. They don't want stocks, they don't want credit risk, they don't even want banks anymore. So they go to the Fed. They hand over cash, the Fed hands over treasuries. The next day, the trade reverses, hence reverse repo. For years, almost no one used it. Then, in 2021, something snapped. Usage went from basically zero to over $1 trillion, then two, then nearly $2.5 trillion at the peak, overnight. No panic, no headlines, just a silent migration of money out of the financial system and into the Fed's vault. Why? Because there was too much cash and nowhere safe to put it. Banks didn't want deposits. Balance sheets were full. Regulations made excess deposits a liability, not an asset. Treasury bills didn't yield enough. Private repo carried counterparty risk. So the Fed became the best deal in town. Risk-free, rate-controlled, infinite balance sheet. Irony number one. The institution trying to drain liquidity became the place liquidity ran to. And the numbers get weird. At its peak, reverse repo was absorbing more cash than many entire banking systems hold in total deposits. This wasn't retail money. This was institutional cash, pension money, corporate treasuries, global capital. Not investing, not lending, just waiting. Waiting for what? That's where the story gets uncomfortable, because this isn't extra money. This is money that would normally grease the wheels of the system. Repo markets, commercial paper, short-term lending, market liquidity. Instead, it's sitting still, earning interest from the Fed, paid for indirectly by taxpayers. Which means the Fed is now competing with the private market using its own balance sheet, quietly. Absurdity moment? Capitalism's safest trade is now lending to the central planner. And here's the math no one likes to talk about. When cash piles up in reverse repo, it means the private system cannot absorb liquidity without stress. That's not bullish, that's defensive. It tells you something about confidence. Now zoom out. The hype says markets are resilient, soft landing achieved, liquidity is fine. Reality says the biggest pools of money on Earth would rather earn a controlled rate from the Fed than touch the real economy overnight. That gap matters because when confidence finally shifts one way or the other, this cash doesn't trickle, it moves fast. If it leaves reverse repo, it has to go somewhere, into treasury bills, into risk assets, into leverage, or back into stress points we haven't named yet. And if it stays, it means the system is still fragile underneath the surface. This is why reverse repo isn't just a plumbing detail. It's a mood ring for institutional fear. High usage means caution. Falling usage can mean risk on or forced redeployment. Neither outcome is neutral. And here's the quiet risk nobody headlines. The Fed is now deeply entangled in short-term funding markets in a way it never was before. It sets the floor, it absorbs the excess, it backstops hesitation, which works until it doesn't, because markets eventually test guarantees. They always do. So the real question isn't why is reverse repo high? The real question is what breaks when this money decides it's done hiding? That's the story most people aren't watching. And if you want to understand where markets go next, you don't watch the noise, you watch where cash sleeps at night. So, here's the unresolved question I'll leave you with. When trillions of dollars choose safety over opportunity, is that patience or is it fear waiting for a catalyst? If you want more breakdowns like this, the stuff beneath the headlines, you know what to do.